Well, as I explained last week on the show, one of the great things about being a stockbroker, as I was for many years, is when the markets are going up, we do these initial public offerings and we price the deals at 10, 20, 30% discount to what would really be a fair market value for these deals. And when you get that first day pop, stocks up 20, 30, 40% on the first day, or during the dot-com era, the first day pop averaged something like 300%. That is then used as currency to pay off customers who are threatening to sue. So any broker out there has at least one lawsuit. And they say the word on Wall Street, when I was working on Wall Street, is that if you don't have at least one lawsuit pending, you're not really trying hard enough. So in other words, if you're really working, you got to have at least one pending lawsuit because it shows initiative. It shows that you're really pushing the envelope. And to pay these people off, typically the proceeds from initial public offerings are used as you would use a slush fund. Now, one of the biggest issues in the last 18 months to 24 months with the collapse of the markets is that there are no initial public offerings. I haven't seen any IPOs in weeks. So the means by which Wall Street uses to commit graft, bribing, payola, has been cut off. So therefore, since people are not getting paid off, since there's nobody paying off the disgruntled customers, the customers are going into court. And they're going to try to get their money back that way. Up until a couple of years ago, customers would just call the brokerage firm and they would get paid off using a slush fund. Now, anyway, so you've got the Wall Street scandal and business scandal. It's now being covered as a scandal, as it should have been covered for the past 5 years, both on the way up and on the way down. The fact that markets were trading at 14,000 on the Dow Jones and NASDAQ got to 5,000 at one point in the late 90s, and the bond market was trading at all-time highs, that's equally scandalous. That's as big a scandal as the Dow Jones down 50% and Bernie Madoff blowing up and General Electric and General Motors and Citibank and Bank of America trading at multi-year lows, multi-decade lows. It's just as much of a scandal when you see these things trading at 20, 40, 50, 60 times earnings. The scandal is both ultra high prices and ultra low prices. Now, if a lot of people are unemployed and a lot of people are suffering, well, it's not just because the markets crashed. It's because the markets were too high due to fraud and abuse and insider trading and market manipulation as well. So the gains that people had, I noticed that the number of millionaires in America was dropped by 2 million. It went from something like 8 million millionaires to 6 million millionaires, or was it 7 million millionaires to 5 million millionaires? Okay, those people are millionaires because of ecological holocaust and ecological degradation for the most part. If you show me someone who's made a ton of money, and I'll show you somebody who has incurred more than that of that amount in irreversible, irreplaceable ecological damage. So it is a zero-sum game in effect. I mean, in America, people love to think of it as being, oh no, it's not a zero-sum game, it's a positive-sum game. It's the American dream. Everybody can get a house and live the life of pleasure, live the life of aspiration. But in fact, it is a zero-sum game in that for all the toxicity that is the externality of the U.S. business model, it ends up getting exported to places like China and India and around the world. So millions live in poverty so that some fat slob in Arkansas can get a cheap trinket at Walmart. Now we're seeing the reversal of that. So, and that's the way the game is played. So 2 points. Number one, what happened in the 1970s? You had the introduction of listed options and the Chicago Board of Options Exchange based on the Black-Scholes option volatility formula. So for the first time, the futures contracts that one associated with agricultural products and were part of the agricultural industry since Chinese rice futures were invented hundreds of years ago.
Japanese,
was very quickly adopted by the financial industry. So you had futures and options trading on bonds, currency, and financial products. which meant that the financial industry could make bets against itself in the futures market. And that's when you had this schism between those inside who were trading purely on inside information and everybody else. And you saw a manifestation of this recently. Reports that Goldman Sachs was making massive bets against their own customers by shorting bonds that they themselves were selling to their customers. That was just one recent example. There was another example last week. One of the major firms, it was either Goldman or JP Morgan.
No, it's Citibank.
And what they were...
they were shorting their own company shares as they were receiving TARP funds and reporting all these losses.
Right.
They made something like $20 million, the top executives there, on shorting the company's shares.
Right. They're making bets against their own company at the same time taking public money into the company. Now, that's all possible due to the options that are trading and the futures that trade on options and options that trade on futures that started in earnest in the 1970s after the Nobel Prize winning option volatility formula hit the streets, and you saw the creation of listed options. So this was why you've got that volatility and why you've got the ability of the financial system to be gamed in new ways. You know, this option volatility formula is like the Einstein's E equals mc squared formula that allowed for matter and energy to be separated and the creation of the atomic bomb. The options volatility formula allows for risk and reward to be separated, and this created the atomic financial bomb, which we now know as the hedge fund industry, which is blowing up the global financial world. And what they've been able to do is to separate risk from reward. Before the options volatility formula, capital was exchanged, and capital had what Keynes, I guess, would call its implied interest rate. You know, every single capital transaction, all elements within the system have an implied interest rate, and this interest rate can be compared. There's a comparative analysis that can be made across the entire spectrum of all asset classes. Now, once you introduce the atomic weaponry of option volatility formula, you can take capital and extricate all of the reward entirely while leaving nothing behind but the risk. And you can then parse the risk and distribute the risk to the general economy while keeping the reward. This was not possible pre-1970s. And this is exactly when Nouriel Roubini says the current economy is socialism for the poor and capitalism for the rich. This is what he's talking about. In other words, on Wall Street in the City of London, in the hedge fund industry, you can put together trades that are incredibly risky. If, in fact, they work and you make money, you keep the winner. If, in fact, they blow up, you dump the losses into these huge passive pension accounts around the world. And this is why you see, or a feeder fund like a Bernie Madoff fund, where they're just passing losses and pass. I know, again, from my own personal experience, what we used to do, and I like to compare what we used to do on the retail level, what's being done on the institutional level. You know, we used to do these look-back trades where you go in the morning and you call the options desk and you say, give me 100 IBM options, but you don't give an account number. Then by the end of the day, if it's a loser, then you give it to a corporation who needs the loss to offset a gain so that it minimizes their tax liability. If it's a winner, you use it as payola to pay off some customer who's disgruntled, or to pay off a customer who then turns around and gives you a kickback. So getting back on this look-back trades, on the institutional level and on the global level, you've got guys like at the IMF and the World Bank and Goldman and JP Morgan. They have these bad bank. They've got trillions of dollars worth of money coming in from the U.S. taxpayer and other entities. And they have a portfolio of accounts. Some of them are numbered, some of them are unnumbered, some of them are on the balance sheet, some of them are off the balance sheet. And they just sit there all day long trying to maximize their gain and to try to hide the risk wherever they can and dump it wherever they can. Somebody's pension account, some Chinese account, some Japanese account. And they're just gaming the system all day long. That's all they do. and the integrity of the entire global financial system is disintegrating. The poverty rates are skyrocketing. The ecology is being degraded as part of the ecological holocaust.